Health insurance companies have made some, I guess I'll call it headlines so far this year. And there's been kind of two main negative headlines that I think have caught people's attention. Number one is something that isn't really, I'm going to say something new. It's a concern over, the idea of Medicare for all, or basically something that would end health insurance as we know it and be more government run. Now, one thing I look at is personally, I just don't see that happening. I think we would just not have the votes in Congress to pass something like that. I mean, even you have, moderate Democrats, many of them would not be for that. And I think, as I said, it'd be very, very difficult to get through really any type of Congress that would be in place over the next few years. So I'm not really worried about that. The other thing that we saw come out this past week was a concern over the idea of people now using more of the kind of non-elective surgeries, kind of what I'll call more optional, not the necessary like must-have surgeries that take place. Now, this is a benefit to hospital operators as it helps with their revenue. We got to understand on the health insurance side, it is a cost because now they have to pay that out to cover those expenses for the consumers that they have that is currently having their health insurance. Now, it is a short-term concern, but one thing I look at is that it could be a buying opportunity to step into one of these health insurance companies that may have gotten hit. Now, today I wanted to cover a company that is kind of not just a pure health insurance company, but it's CVS. We know they have all the different retail side of the equation as well. They have all the different brick and mortar stores around the country. Now, it could be a benefit to them, but it has also cost them lately, as we know, retail theft has been quite high and has also dinged their earnings as expensive have gone up for that. So interesting company here. Let's take a look at the numbers for CVS to see what a buy or hold or sell would make sense for CVS at this point in time. Here we'll start with, again, CVS. They're in the healthcare plans. You might be saying, what are you talking about? CVS has healthcare. You got to understand they own Aetna. Now, Aetna is a large player in the health insurance space. So we look here, short percentage of float, it's only 1.2%, not so much shorts there. Large institutional ownership at 82.6%. Price to earnings ratio of 23.1, slightly above the industry average of 20.3. Price to sales looks very good at 0.3 versus an industry average 0.7. That could be a benefit from all the small items that they may sell in their brick and mortar side of the business that the other health insurers don't have. We see price to book value is 1.3, but price to tangible book value is not material. That likely stems from the acquisition they had of Aetna, created a lot of goodwill on the balance sheet, which now they don't have that material book value. Looking at price to cash flow, that's very strong at 4.6, below the industry average at 8.2. And I like to see this PEG ratio at 1.7, tells me you're not paying much for the future earnings growth of this company. This is a concern here. You see earnings per share down 49.9% over the last year. Curious where that is stemming from, if that's from the health insurance side or from, again, the brick and mortar side. See, sales, though, were up 10.4%. So how do you have that dichotomy between increasing sales and declining earnings? Obviously, expenses had to be a large component of that. Are those one-time expenses that occurred, or is it a fundamental problem with the business, something to have to dive down deeper into? See, 5-year earnings per share growth going forward here, 4.5%. I mean, not explosive growth, but hey, I'm happy with around a 5% earnings growth rate. That's an okay rate considering what the valuation is going forward. It could make some sense. Looking at the dividend, you get a nice yield here of 3.5% for the business. They use about 74.9% of their earnings to pay that out, also known as their payout ratio, higher than I'd like to see. So I want to see if that payout ratio is going to decline going forward, hopefully due to earnings growth. One other thing here is the buyback yield. See, that's 4%. And this is one thing I really like about insurance companies is they do buy back a lot of stock, which in the long term can really help the shareholders as they're reducing the shares outstanding, which means now you get more of the earnings, more of the sales, more of the assets, more of the cash flow for that business. So share buybacks at the right level can be a huge, huge help. Looking at the balance sheet for the business, you do see a current ratio of 0.9 above the industry average 0.6. I'd like to see a little bit more liquidity on that balance sheet, especially debt to equity at 110% or 1.1 versus the industry at 0.8. A little bit higher than the industry, but not in the danger zone just yet. I will point out sometimes insurance companies do carry a different type of accounting, so that could have an impact on the balance sheet as well. Looking at the profit margin and the net margin, 1.2%, that is low. That may again stem from their brick and mortars. They're not making a huge margin on many of those products that they sell. Looking at the return on equity, 5.5%, return on invested capital at 4.2%. I'd like to see both those ratios higher. Current price here for CVS, $69.47. The 52-week high is $107.26. So it's gotten beaten up pretty good here. And the 52-week low is $66.34. You see year to date, the stock is down 24.3%. Now going forward for CVS, we go out to December 2024. I do see estimated earnings per share of $8.90 would give us a target sell price of $147.74. You can see they traded a forward PE of about 7.5 times. Going back to that estimated 5% earnings growth going forward in the next 5 years, I mean, having a company trading under 8 times earnings with a 5% growth rate, I think that's quite a phenomenal opportunity. When I look at this business, I do think I'm quite excited about CVS. I think there is some positives in terms of the valuation of the business. I think right now they're in the midst of a lot of negativity, which is when I generally like to step in and buy things. We're contrarian investors, so we don't like to buy the things that are hot. We like to buy things that are having temporary problems. And especially when you look at the concerns over the non-elective surgeries and kind of short-term expenses there, that's a beautiful thing about insurance companies, is as those expenses come in, many times they do increase their insurance rates going forward to offset those expenses. So they're really able to maintain good margins. I like the insurance space. I think CVS makes some good sense here. It does require a little bit further research, but overall, I'd say I'd rate it a buy at these levels. Now, if you find this video helpful, you're looking for more kind of investment tips, stock advice going forward, be sure to subscribe to our channel as we try and do these videos on a more regular basis.